All right, folks, it is Friday, June 27th, and this is now the Daily Scan. The time is 2:41 in the afternoon. I have things to do tonight, so I'm not going to wait till the market closes. We'll take a look and see where we are. I've got quite a bit to cover, some things I want to show you, and then I want to answer a lot of questions. A lot of really good questions came in yesterday and a few this morning. And I encourage you to ask any others, and I'll try to answer them as much as I can. So let's jump into it. Of course, I'm not a financial advisor, so this is all for educational purposes only. Past performance does not guarantee future results. Now we have that out of the way. Let's first take a look at the 10-minute charts like I did this morning and see what might have changed, if anything. So here's the aggressive sectors. Now the market's coming down. Oh, now it's below. So it may close below the all-time high. That's not what we want to see. And it may imply that Monday is going to be a down day and the market might start to pull back from there. It's almost like it just wanted to log that high, so a new all-time high. It is a new all-time high. It's just not a new all-time closing high. And now it's pulling back, so it needs to be above 61.47, and right now it's at 61.35. So we'll continue to watch that, see what happens. Aggressive sectors are pulling back a little bit. Communication is actually continuing to go up, but they're actually hanging in there pretty well. Defensive, down to the bottom. Staples coming up a little, but they're still pretty much where they were. And then the rotation, growth versus value is flat. Discretionary is pulling back a little bit, but kind of even to where we closed yesterday. Technology's coming back some, semis coming back a little bit. So a little bit of a pullback. It looks to me like the market just wanted to log that new all-time high. And once it did that, it says, all right, we're done. I'm out of here. So just before the weekend, lots of traders out there probably want to go into the weekend flat. So it's selling off right now. We'll see. We'll look at that again later before I close the session, which might be around 3:30. So it'll still be before the close. All right, a couple of things I wanted to show. One I mentioned earlier is I've added platinum to, if you go to the market bias matrix page for subscribers, you can get to this page and see all the different categories here. These are all the different asset classes that make up the market on a short-term, medium-term, and long-term basis. So indexes, sectors, industry groups, intermarket relationships, commodities, metals, and currencies. And I just added platinum in here to metals, just below silver, because it's a white metal. And then over here, it shows you the overall trend based on this going back to March. You can see the overall trend. This has been incredibly accurate so far in identifying turns in the market. And down here, you can see the short-term in orange, medium-term in gray, and long-term in yellow. Long-term is starting to creep back up, while the short and medium-term are staying up there. So that's all very bullish for the market. But I added platinum down here, and you can see platinum continuing to outperform. It gave a short-term bull signal way back here in April. And it gave a medium-term bull signal right here in May. And it gave a long-term bull signal back here in March. So if you're watching all of those, and I will be watching those now that it's part of the matrix, then I will be identifying when those things change. But you can see for now, they're all bullish. So platinum is right here. You can barely see it, but they're all bullish straight across. And if you want to get a better view of this, you can actually download the spreadsheet right here. And the spreadsheet has links to all of these things right in the spreadsheet. So that's where the download is. All right, let's take a look at the S&P real quick. So you can see right there, that is a shooting star. That's a failed breakout. So if it holds like that into the close, then I pretty much will guarantee the market's going to sell off next week. I hate to say guarantee, but more often than not, I cannot tell you the number of times when I see a shooting star candle at the top of a run that almost always it starts to sell off the next day and after that. So I've got to the point now when, we don't know what it's going to look like at the close. So I'm just showing you this right now at 2:45 Eastern time. But if it does look like that at the close, then I have become accustomed to just getting out, either index or stock, whatever. Whenever it does a shooting star at the top of a run, I just get out. Don't ask questions anymore. I've been burned too many times expecting it, saying that, oh, maybe not this time. Maybe this time it's different. But usually it's not. So NASDAQ 100 is the same thing. Went up almost to the expected move, right up there. And somebody mentioned I should explain how the expected move is calculated on Technical Tuesday, which I will do that next Tuesday. So there's the NASDAQ 100, looks the same, and Bitcoin. Bitcoin also is pulling back. That's not really a shooting star, but it's a red candle, so it's pulling back to this 106 level, that very important 106 level. So that's where the market is. All right, a couple of other things I want to show before I get to the questions, the Q&A session. One is liquidity. I had mentioned this previously, but I didn't show it. So somebody was talking about oil and how some analyst was expecting oil to get to $55. So I have this liquidity chart right here for subscribers. It's in the blue column underneath other relative charts. So liquidity shows the dollar, oil, interest rates, and manufacturing. Also shows commodities. So here's what it looks like. Here's the dollar up here. Right down here at this level, which is the 0% level, by the way. So below this is bearish, but you can see how long it's been declining. So the US dollar is going down. Oil started to go up and now it's collapsing. Commodities started to go up and now they're collapsing. 10-year yield is now moving lower, like I said that it probably would. So all of those create liquidity. Manufacturing is not part of the liquidity equation, but oftentimes when there's more liquidity, manufacturing begins to pick up. But there's a lag time. It takes some time for that to happen, usually about 10 to 12 weeks. So you can see that when this started back here, about 12 weeks later is when the VTI, which is the total US market, started to pick up and move higher. So it's sitting right now right at the all-time highs. We'll see if it closes there. It's already made a all-time high. Just hasn't made a closing high yet. All right, so the important thing about this is, as far as global liquidity is concerned, if the dollar goes lower and many other countries are denominated in US dollars, so if there's a cheaper dollar, that means they can refinance their debt with cheaper dollars at lower rates, giving them more money, so more liquidity. If oil, and every the industrialized country uses oil, so if oil is going lower, that allows them to save money, not spend so much on energy, and gives them more money, so more liquidity. Same thing with commodities, same idea. When commodities start to go down, which they often do along with oil, then countries have more money and more liquidity. And the 10-year, the same thing. The 10-year keeps going lower, then interest rates are lower and people can refinance. So when liquidity is improving, that helps the stock market. That's really, really important. When all of these things go up, like they did right here, interestingly, you can see this blue line right here, which is right in January. That's when they hit the peak and the market rolled over. Down here, you can see it. So this vertical blue line is where they all hit the peak. And just a couple of weeks later, the market rolled over and started going down because liquidity was drying up. Liquidity was being reduced. So money was being pulled out of the market. So better liquidity means higher prices. All right, so I wanted to show you that. One more thing that I've added is a crypto chart. I saw something earlier today that I thought was interesting, so I created a chart, as I often do. And it was comparing Bitcoin, Ethereum, and Solana to each other. And this performance graph goes back 1 year. And what you'll see, so this goes back a year, they all start at 0. So it is a performance graph, meaning these are all relative to each other as far as performance is concerned. and they all start at the same place 1 year ago. And what you'll notice is the red line is Bitcoin, the blue down here is Ethereum, and the green is Solana. Now, Bitcoin and Solana are moving almost hand in hand, but Ethereum is following along pretty much the same way. So these have been very highly correlated up until right about here, right about the April 7th was the bottom in the stock market, right through here. Let me turn this on. So April 7th that's April 8th, actually, right there. So April 7th was the bottom in the stock market. The market began to recover at that point. That was the bottom for crypto. They all started to move up pretty much in unison together. But then when we got here in May, Bitcoin continued to go higher, but Ethereum went lower and Solana went sideways. And then when we got to here, which is the peak for Bitcoin, May 22nd, Ethereum had already started going down. Now, Bitcoin just went sideways, but Ethereum is falling, and Solana now is falling as well. So they are no longer as tightly correlated with Bitcoin as they were. So what that implies is you can't assume that if Bitcoin goes up, then these are going to go up as well. Just recently is showing that they're not doing that. They're doing something different. All right, so I wanted to point that out, show that to you. Let me go to the questions from, let's see, was this yesterday? Now let's go to yesterday's questions. And I'll try to get to all of these if I can. All right, first one is Russell 2000 and a bearish wedge. Let's look at the Russell 2000. Let's do it on this chart. IWM, Russell 2000, there's what it looks like. Is there a bearish wedge? Well, it looks very much like the bearish wedges from all of the other ones that I showed you previously. So if we draw a line, we'll start at this high right here and go right across these highs like that. So that's an uptrending angle. And then if we go across these highs like that, yes, you have a bearish wedge. You can take it from here, from this point right there. You still have a bearish wedge. This probably comes down a little bit. So right about there, pretty much the 21-day moving average. And you can see that the Russell, along with the other indexes, tried to break out and is pulling back right now. That's not exactly a shooting star, but it's pretty much got the same idea as a shooting star. It's a failed breakout, basically. So try to get above this resistance line. If it stays like that into the close, then this is the 21-day down here needs to be support. If it breaks through that, then bearish wedges usually resolve to the downside. So this would break through there. So that's what would happen with Russell 2000. So yeah, good catch, person that mentioned that, at Kevin St. Aubin. So again, we have to watch it. It's pulling back right now, right to the 200-day. So we'll see if it stays like that. Watch it into the close. SoFi, the next one somebody asked about. SoFi. This is consumer finance. You can see right up here. And I think you're going to see this on a lot of charts today. Look at that. That is a shooting star candle. That typically is a reversal, fail breakout. We'll see if that holds into the close. So watch it and look at the close. This looks like maybe a long cup and handle all the way back to 2021. So let's go back. There's a cup for sure. Back to 21, that's really long. So let's do a weekly chart. So that's all the way back here. So it could be a very long cup and handle. Normally, let me show you this. This is a favorite pattern from Investors Business Daily. So there's the cup, kind of like that. And then the handle would be formed right here. Now, normally you like for the resistance at the top of the cup on the right-hand side of the cup to be equal to the left-hand side over here. But because this is such a long period and this is a weekly chart, then there could be a little bit of leeway here. So the idea about this is, as I've said in the past, charts are basically a visual representation of market psychology. So everyone that bought into SoFi way back here, which was, let's see, back in here, which was at about $23. And it just went all the way down to $4. So all of these people were trapped over here. They spent a long time from 21 to 25, 4 years, waiting for it to come back up. And it finally came back up. And because this is such a long period, then this actually could be a handle for this cup. You'd like to see it up, right about where resistance is up there. But all of these people are in such pain for such a long time. They just want to get close, and they want to get close to break even and then get out. So that's what forms the handle. So the handle now is formed and it's starting to move up. So in this case, there's two breakouts for this one. In this case, it would be the breakout of the resistance for the handle right about up here. So at about $18, it's at 17 right now. And then the second one is up here at the close, at this one way back in 2021. So there'll be another level right there where it could run into resistance. So that one is at about 23. This one's at about 18. So you have to wait to see if it breaks out. It could come up here and get rejected and go right back down again. But yes, that could be a very long cup and handle on that. So I'd watch it up here around the 18 level. If it breaks out there, then there'll be buy orders sitting right above it, and there'll be more buy orders up here, up above 23. There'll be more buy orders. So if it breaks out of this one and breaks out of this one, then it could actually continue much higher. All right. How important is it to use prices that are adjusted for dividends? My understanding is that swing trading and long-term trading, it's better to use dividend adjusted prices, but for intraday trading, unadjusted data might be better. We'd love to hear your take. Okay, so first of all, in general, that's probably true. Intraday trading, if you think about it, if we look at this chart for SoFi and look at it on a 10-minute chart, let's see, right here's my 10-minute chart. So here's the 10-minute chart. If you're doing day trading or intraday trading, then your time frames are very short. Here's 1 day right here. So if you're doing an intraday trading, then you're taking it from here and you're getting out over here. Most likely, there's no dividends even to consider in that period. It would be extremely rare. It doesn't mean that it doesn't happen, but extremely rare that you're trading intraday during the dividend day. That's once a quarter is when dividends come out, typically for most stocks. So yes, dividend adjusted really makes no difference, doesn't really do anything for intraday trading. Now, for long-term trading, and I'm not sure if stock charts is dividend adjusted or not, but that could come into play for longer term trading. One thing that I have on the website for those that are subscribers on the portfolios page are all of these dividend stocks that I did a scan for at the beginning of the year and put them all into watch lists over here for different criteria. So one with dividend yield, one with 12-month performance, and one with technical ranking. And you can see where they are right now. This is as of the end of May. I will update this over the weekend. You can click right here and actually look at the stocks that make this up. So you can see at the end of May, the 12-month performance one, that group was up 5%. I don't know what it will be in June, but I'll do that over the weekend. So these are dividend aristocrats up here. These are dividend champions. similar to aristocrats, but they don't have to be in the S&P. And in this case, the dividend yield one outperformed 7.5% as of the end of May. And then down here are the Vanguard high yield and high performance, which just so happen to be the exact same stocks. So these have the same performance because they are basically all of the filters that I ran return the exact same stocks. So there's no difference. You'll notice up here there's a difference between each of these filters, but there's no difference on these because they're all the same stocks. However, in this case, it's up 8.6% as of the end of May. So we'll see what it is at the end of June. If it's up, let's say it's up 10%, that's halfway through the year. If it continues at that pace, then it's a 20% gain. And in this case, these will include the dividends. So at the end of the first quarter, I calculated the dividends and added it to the price, and then calculated what the performance was. Now that we're in June, it's the end of the second quarter, end of the second quarter, then I will add the second quarter dividend to the price as well, and the performance will be reflected using dividend adjusted pricing. So in general, I think your comment is accurate. I just don't know for sure if stock charts or any other platform shows you dividend adjusted prices or just regular prices. I just don't know. Next question from Bilingual Papa. Having a watch list has been very important to me, allowing me to jump on the train relatively quick. I'm taking full advantage of the upside momentum. Yeah, this is really important. Creating a watch list is really important. When you see me do the daily scan, I identify certain stocks that are starting to make a move. However, many times it's catching those stocks a little bit after the fact because I'm doing a scan on a whole universe of stocks. If you had a specific number of stocks that you watch every day in a watch list, certain ones that you like and you like to keep track of, then you will actually see the stocks moving before the scans will identify them. So you can actually jump in earlier if you create a watch list and are disciplined about looking at that watch list every day. Google Head and Shoulders top potentially forming on the weekly chart. Let's find out. So let's go to Google and go to the weekly chart. And yeah, it is potentially a Head and Shoulders. Right now, it would be a little bit slanted to the downside, which actually implies that there's more downside potential. So there's the neckline. The head is here. The left shoulder is there. Right shoulder looks like it's forming right now. Right shoulder is right there. Now, as I've always said with Head and Shoulders patterns, they are not a pattern until they complete, until they execute. All right, so what does that mean? In this particular case, it is the distance between the roughly around where the head is. So let's call it right here, 204, let's call it the top of the head, down to the middle of this diagonal neckline, which is 145. So 204 minus 145 is 59 points. Let's call it 60 points. So 145 minus 60 is a target of 85. So the target is way down here where the low is, way down here. So that's the target on that particular Head and Shoulders. That's a long way to go, but again, a Head and Shoulders pattern is not valid until it breaks this neckline. And notice that the neckline is right at the 200-day moving average. So I suspect that is probably going to become a support right there, right at that neckline, and probably will not break through it, probably will bounce from there, and then it is no longer a Head and Shoulders. You can put these little marks on here like this if you want to, just as a visual reference of where things are. But as soon as it does something different, as soon as if it reverses right here and goes back up to where the head is, it's no longer a Head and Shoulders. So you take all of these things off. If it goes down here to the 200-day and bounces and starts going back up again, it's no longer a head and shoulders. Then you would take all of these things off. It just gives you a sense for where it might be headed, but you can't predict anything with the market. But yeah, on the weekly chart, that's a good catch. That is, absolutely looks like a head and shoulders. Hearing chatter about IPO season. Love your analysis of Symbiotic. Let's see. Don't know that stock. Symbiotic. Okay, starting to move up. It's at $36 right now. This is a weekly chart, by the way. Here's the daily. So in this one, pretty choppy. So it's got resistance right there, basically 40, 41. So likely it's going to stall when it gets there. Might even be stalling right now. If the rest of the market goes lower, then it could be stalling right there. You can draw, you can see roughly through those tops right there. So it's sitting right at the downward diagonal resistance line. The moving averages, it's above the cloud, and the moving averages are moving up, which is good. It's got a shooting star. We'll see if that holds into the close. So that might be a reversal. So that could be what happens on this one. Let me go back. I want to go back on this. See how far back we can go. Now this is a daily chart. So let's go back, let's say 5 years. Yeah, so here's probably the IPO was back here. It did nothing for a long time until 22. That's kind of weird. I'm not sure what's going on here. If that was the IPO back here in 21, it wasn't until June of 22 that it started to move. So it went up, pulled all the way back, even to the lower than the low, and then went all the way up again. It's made it to 64. Right now it's trying to make a run again. And from this perspective, we could draw another trend line basically across these. So you can see it's already broken out of that downtrend line. And now it's going to try to break out of this one. And then it's got a lot of resistance as it heads higher. So, but that could happen. I mean, this one looks like it's trying to recover. Got a double bottom right there. So we'll see. It looks pretty good right now, but we'll see if the rest of the market cooperates. That's the key. All right. Stocks above the 20 has a divergence, and stocks above the 50 is just starting a divergence on the SPX. Could be a sign of caution. That's from NAM 1 on 1. NAM 1 on. Sorry, NAM 1 on. Yeah, that's a good observation. Let's go back and look at that for subscribers. If you go to the charts page, and there's a couple of places you can do this down over here on the left-hand side under the daily routine. There is the 50-day and 200-day analysis right here. So this is the SPX. So you've got a positive, the market's going up. You can see the failed breakout right there. Market's going higher. And then down here, you can, let me turn that off and let's draw the line in here. So here, stocks above the 200-day. So we want to take it from the same place. So from this point right here to this point, and then we go up here to the highs, basically where this breakout was right here. And this one, stocks above the 20 are lower. So there are fewer stocks above their 20-day, pushing the market to higher highs. Similar on the 50-day. So in this case, it's not dramatic though, but there are actually fewer stocks on the 50-day, and the 200 right here is the same way. So there are a little bit less stocks on the 200, but the 20 usually leads. That starts things off. So yes, we may be getting close to the market rolling over. These are all bearish divergences. There's lots of ways you can identify divergences, but that's a really good catch. It's always important to watch for divergences like that. So this one definitely looks like a bearish divergence. So good catch on that one. Thoughts on energy ETFs? Let me see. This is from Power Up 032. And the stocks are URA. Yeah, this is uranium has just been on a tear because everyone's going nuclear lately. So let's look at this on a weekly chart. You can see right there, it definitely has broken out. It's probably a little too late. I wouldn't get into something that's already that extended right there. But you can see what I always point out is when it closes above the 21 and you've got a green bar with coming after 3 not green bars, either blue or red, which is exactly what this is right there. So that was the entry point. This is the value of having a watch list. This is if you're religious and disciplined about looking at your watch list, and you watch it each day and you continue to see this thing falling, and then you see it start to recover. And right here on April 28th, it closed above the 21 day, and it closed with a green bar after 3 not green bars. All right, so that closed at 25.84, and right now it is at 37.97. So that's about 12, 13 points in about 2 weeks. That's roughly about 30%. 30% gain in 2 weeks. Not bad. So that's the value of having a watch list and checking it out all the time. But yes, uranium has been really good. The next one, MLPA, which I'm not familiar with that one. MLP looks like I don't know what MLPA is actually, but again, in the energy sector, it's made a really nice run. Had a big pullback right there, and now trying to climb back up again. This one to me could continue higher, but we'll see what happens with energy, because I think oil is going to continue to drop lower. I think gold is going to continue to drop lower. Go back over here to the matrix. So I showed you oil before. Right there, that oil, it's really just definitely collapsing below its uptrend line. So that one's heading lower, and I think it probably will continue. Oil, we'll look at Brent crude right here. So there's oil, big, huge drop off after the weekend, continuing to go down. By the way, I have something in this week's newsletter that shows that 85% of Iranian oil is bought by China. 85%. There's a graph. It'll be in this week's newsletter. For those that are interested, the newsletter can be found right on the main page of the website, breakpointtrading.net, right here. You can download the free newsletter. So there'll be a graph in there that shows that 85% of Iranian oil goes to China. So why would it make sense for Iran to close the Strait of Hormuz? That's where all of its oil goes out, and its main customer is China. I don't think they really want to piss off China, who's buying 85% of their oil. So just my opinion. I could be wrong. All right, let's go to today's questions. Still makes sense to get it. Does it still make sense to get in? Monday usually is a bad day. Might pull back a little. Yep, it could. My comment on this was that's the reason. This is from 8269 WD. That's the reason why most financial planners don't recommend you trying to time the market, because you can identify when to get out, or you can never catch the absolute top or bottom, but you can pretty much know that the market's starting to go down and get out. But the hard part is getting back in, because the time to get back in is usually the scariest time. So the time that you won't want to buy is usually the time that you should be buying. And that's the hardest thing for most people to do. Now, one thing I have on the website, on the portfolios page for subscribers, and this is something that I put together after seeing an actual financial planner at the Money Show, Turner Capital, And they do this for their clients. And they had what they call a proprietary method, rules-based method. And I basically deconstructed that method and recreated it. So these are the rules right here. It explains exactly what they are. And then I update this every day on what the status of this is. The actual process is based on a weekly chart, but you can also use a daily if you want to get in and out earlier. The weekly usually is the goal is to capture long-term capital gains. So you can see on the, make this a little bit bigger, on the, I don't think I can move sideways. So, all right. So on the long term, the weekly one, it gave the signal on May 5th, and it is still a long signal. So it's up 9%. The daily gave the signal on April 25th. And even though the long-term signal here is still bear, it has not switched over to cash. So the strategy signal here will be either long, cash, or short. So if it's long, you can either just play it straight. You can use VTI, you can use the S&P, any of the indexes. You can use a single like SPY or triple Qs. Or if you want to be more aggressive, you can do the double leveraged for S&P, NASDAQ, or Russell 2000. Or you can do the 3 times leveraged for each of those, both on the upside and the downside. So you can make money when it goes down as well. So what I've shown here is if you're just using the single right now, ever since April 25th. So we are today at June 27th. So that's 2 months. That's 11% in 2 months. If you were using the triple, you'd be up 34% in 2 months. So that's pretty much how this works. And I update this every day, and this will tell you when the signal has switched over to cash, when you should get out of this long position and switch over to cash. At the same time, it will tell you when to get back in. That's the hard part, getting back in. So right now, the market has moved up so much that the question was, does it make sense to get in now if you're not in? Well, I can't really answer that. That's each individual's preference, depending on your trading style, depending on your risk tolerance. But at this point, you probably would use the daily chart to make that determination. And you can see on the daily chart, it's pretty extended right now. It's starting to pull back. So what I would do if I wanted to get in, I would wait to see it a pull back to the 21-day, just like it did back here, June 23rd, just like it did back here, May 23rd. Wait for a pullback down here to the 21, and then make sure that it's going to continue to go higher, because it could pull back here and just keep on going down. So the 200 and the 50 are at almost the same place right down here. But that's what I would do. I would wait at least for a little bit of a pullback and then get in and then start watching the long term for the signals. Or you can stick with the daily at this point, since the long term is so far, it's been up for so long. You can just wait. You can just look at the short-term signals and get in and out that way. But that's my recommendation. Just watch this. It makes it very simple and easy. You could try to look at the signals up here and try to duplicate those, which you certainly could in your own account. I charge $99 a year for this. It's pretty cheap. Or you can just follow this. You can just wait, look at this each day at the end of the day, look at the date up here. So that's from yesterday. And then see whether this has changed to a cash signal, which it won't. Here's the weekly. Based on the weekly, I'll look at it right now. So yeah, so the weekly, it's still up pretty considerably. So it's not even close to giving a cash signal yet. And these are all green bars. The cash signal won't come until right here when it closes below the 21 on the weekly chart. Notice back here, it came down 1, 2, 3 weeks in a row. These are weeklies, 3 weeks in a row. But this week right here, even though it went below the 21, it did not close below it. So the weekly chart waits for Friday to make a move. So in this particular case, it did not take you out. So you got in way back here and you stayed in all the way to here. So you got in here on October 30th of 23 and didn't get out until March of 25. So that would have been long-term capital gains. Anyway, that's how that works for subscribers. You can always check this out and look at it, see what it's doing. Next question. Oh, this is a good one. I'm gonna answer one other one. Yeah, there's only one other one on here. So, how do I feel about UNH, United Healthcare? Let's take a look at UNH. I did answer this on the YouTube channel, but here's United Healthcare right now. Let's see, it's at 307.58. So I bought this at 292. It's been very well behaved. After it came down to the bottom, it's just basically been going sideways. It has a major squeeze going on it. Let's see if I can show it here. So here's the squeeze on UNH. You can see that it's been in a squeeze since beginning of June. So big long squeeze right now. This probably will start to take off at some point. Keeps going up to the 21 and getting rejected. But what I've been doing with this, I got in at 292. Can't remember where, but somewhere back here. And every week, this has weekly options. Every week I sell covered calls. So I make an income. And every time I sell the covered calls, they're roughly around $2 each week. And I keep lowering my basis every week. So right now my basis, instead of 292, which is where I got in, it's now at 283, where we are right now. And the covered call for today, I sold that last Friday. The target was 307.50. And you can see right now, right at the top up here, it's at 307.45. So this could have been called away today if I'd waited, but I exited that trade this morning because I had just about an 80% gain. So I exited that trade, and then I did another one for next week, for 1 week from now, but this time it's at 315. So United Healthcare would have to go above $315 by next Friday in order for it to be called away. And of course, if it was called away with my basis now at 283, I'm going to make a nice profit. And if it doesn't get to 315 by next Friday, I will just do it again. I'll just keep selling covered calls week over week, and make $2 in income plus the dividend whenever the dividend gets paid. So anyway, that's what I'm doing. That's what I think about UNH. I think it's this to me is like a Warren Buffett kind of stock. This is probably around over here is where Warren Buffett probably got in, and he would just hold this now forever. All right, so last question, and then I will have to wrap it up. And this is a really good question, so this might take a little bit of time. The question is, let me find a good chart to use. I'm going to use the SPX. The question is, this is from TJ4 USA, TJ4A USA. Do you still believe the end of July to October period to be a tough period? Let's take a look. So I'm going to use the S&P. I am going to use this chart. Turn that off. Down here, instead of price performance, this compares the symbol to the S&P. I'm going to use the PPO, which is a MACD. I'll remove the scooter line because we don't need that, but I'll leave the volume and everything else in. All right, so there's what the chart looks like right now. So let's go back in time. Let's do a little time travel. And I'm going to go down here and select the start and end date. And I'm going to start in 24. I'll start on June 1st, and I'll go back to 24 again. I'll go to December 1st, 24. So this is last year. So notice right here, July 15th. Remember I said the third week of June until July 15th is a bullish period. Well, there it is from last year. There's a bullish period. But look what happens on July 15th. Market came down, came back up, but it never got higher than this one. Came back down again, and then right around here, the end of September, first part of October, is where it took off for the rest of the year. So that's what it looked like last year. Now, everyone can make their own decision of what they want to do. If the market is going to go up Monday, if you want to get in right now, or if you want to wait for these things to happen. But that's last year. Let's look at the year before. So we'll go to 23, June 1st to 23, December 1st. All right. Now, in this case, July, it's almost the end of July. So it went a little past the 15th. The 15th is right here. It didn't go up much after that, but then right after that, it started declining. So it came down, it came down, it came down right until the end of October. And by the way, most bear markets, the majority of bear markets end in October. So this one was right the third week in July, ended in October before it started to go higher. So that's what 2 years ago looked like. Let's look at 22. 22 was a cyclical bear market. Let's look at 22, December 1st. Now, in this case, we had already been coming down. We've been coming down for the whole year, ever since January. Notice where the 200-day is, way up here. So we came down, and right here at the beginning of July, which is pretty much where we are right now, except for this time, we've been going up. So remember in 22, we had been coming down. This time we've been going up. But in 22, the market went up, had a nice little rally in July, beginning of August, hit the 200-day right there, and then sold off pretty hard all the way down here to, you guessed it, October. From October on, it started climbing, and it continued to climb after that. That was actually the low for this previous period. All right. So again, it's not always July 15th. It's not always, that same period. It depends on what the market's been doing. This year it's been going up. This in 22 it was going down. But that's the week period right there, July to October. Let's look at 21. Here's 21, June 1st to 21, December 1st. Now in this case, in 21, remember, it was coming right out of COVID. The market had just kept going higher. Everyone was sitting at home using Robinhood, becoming traders. In this case, the end of June, it went up. It sold off a little bit right here, right after that July 15th period. So it did have that, third week of June to the middle of July. That's that bullish period. Then it sold off, and then it continued to go up. It went up, and then it had a big sell-off here until, you guessed it, October. And then October is when it took off. All right, so that's 21. Let's go look at 20, the COVID year. June of 2020, right in the middle of COVID, to December of 2020. Now, in this case, you can see June right here. Now, started actually the end of June, started to go up and during that rally period, but it didn't stop in this case. It kept on going right until the beginning of September, and then sold off in September, tried to make a recovery, but didn't get back to the high. And right here, the end of October is when it started to move higher. So that was, hopefully you're starting to see a trend here. Let's look at 2019, June to 2019, December. In this case, here's the June period. So it actually started earlier in June, the beginning of June. Right up here to the third week of July was the peak. A little bit after the 15th. So the 15th was here, pulled back, went up a little bit more, and then sold off until September, went up a little bit, but didn't make it back to that same high. Came all the way down here, putting in the low right here in October, of course, and then took off from there in October. So that's the same, middle of July to October period. In this case, it just went sideways. That was 2019. Let's look at 2018. June 1st, 2018, December 1st. In this case, you can see right here, June, sold off actually in this case right to the beginning of July. That's not what we're doing this year. We're going up this year. But the beginning of July, it started going up and it continued to just go higher until this one did not go down in 2018 until we had the previous trade war. So the trade war started right here in October, and then it sold off right into the end of the year, actually even in December. Sold off some more. It didn't recover until I think it was Christmas of 2018 is when it really started to recover. So this was a little bit different between that June to July period in the sense that it just kept on going from July until the beginning of October and then sold off. All right, it's 2017, June 1st, 2017, December 1st. Here we are in June. Here's where we are right now, the end of June, beginning of July right there. Went up until the third week of July, sold off till August. And then in this case, it started going up in August and September and just kept going higher in that particular case. So that was 2017. So 2017 was a pretty good year. Did go sideways through the beginning part of this July, August, September period. But in this case, in September, instead of in October, September started the rally to go back to higher highs. And then the last one, let's look at 16, because this was an election year, December 1st of 16. In this case, the big sell-off was in June. So the whole month of June, which we didn't get this year. This is not what this year looks like. And then it rallied, went up in July, and then kind of went sideways through August, September, and then started selling off leading up to the election. And then right here is the night of the day of the election right here. It was November 5th, I think, was the election day right there. And that was Trump's first term. And right after the election, it just took off from there and continued to go higher. So looking at all those years in general, not every single time and not always in the same point, but in general, you can see the weakness is usually from that 1st of July, middle of July period until October. So keep that in mind if you're looking to get in. I'm not saying that's going to happen this time, doesn't have to, but that's what history tells us. That's what the history looks like. So we actually look at the historical chart, which I've showed before, and I put it on the newsletter last week. You can always go back and get last week's newsletter. It's still out there on the website. So this is what July looks like. You can see right here in where we are is right over here. We're not quite in July yet. This will be Tuesday. So it looks like a bit of a sell-off until right after Independence Day, and then it just takes off and goes higher. And then right over here at the end of July starts to go sideways. So historically, this is the strength, that bullish period until around the middle of July. CPI report comes in on the 15th, and the FOMC meeting is on the 30th. So those are going to be important dates in July. All right, that's it. Sorry, it was a long one today. Hopefully you got some information out of it. Thanks for all the questions. I tried to answer as many as I could. If you have any others, let me know on any topic. I did have a good suggestion for Technical Tuesday, which I'm going to do. This is from Online Active 01. Can you cover ATR, which I certainly will. And then that's number one. And then number two, expected move. How do you calculate it? So I'm going to recalculate the expected move for the S&P and the NASDAQ later tonight. So you'll know what it looks like for next week. And the expiration, of course, is the 18th. All right, before I go, let me go back and look at look at that. We're coming back up. So we went down a little bit below today's open, and now we're starting to rally back up again. You see, money's moving back into growth, back into discretionary, a little bit back into semis, back into internet. Right now we are at 61.50. So if we closed right here, we would close at an all-time high. We have already made a new all-time high. So watch this now into the close. It's 334. So we've only got 25 minutes left. So if this continues to climb into the close and goes up, then we will not only have a new all-time high, but we should also have a new all-time closing high, which will be great. So 25 minutes left. Good luck. And I will have a nice weekend, and I'll talk to you later. Take care.